This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
War erupts in the Middle East, adding unanswerable questions for investors, especially those trying to guess where the markets are going to be in a month. On this week's show, we provide some perspective on what's playing out and what it means for your long-term investments. Welcome to the Wise Investor Show podcast. I'm Chase Hinderstein, and obviously it's been a wild week in the markets with a few stories being able to pierce through the headlines of the war in the Middle East, and that makes it hard to publish a podcast that's going to be heard 3 or more days later. As, you know, calling this situation fluid just doesn't do it justice. But I'll try to focus on some of the facts as we have them and add a bit of perspective with a departure later on in the show to focus on an individual company. For some real perspective, because I have heard a limited bit of panic out there, especially when we saw days with the Dow down at times over 1,000 points. But where we stand at the moment, as I'm saying this here on Thursday, the S&P 500, it's down about 0.3% since the close on the Friday before the day in which we attacked Iran. That's on the heels of a pretty volatile February, which had less to do with the Middle East, and we should keep that in mind, that there were already these threads to pull on before this all started, as the markets declined a bit less than 1% for the month. And as dramatic as it's been, at this moment, the S&P 500 is actually about dead flat for the year, right where it closed on December 31st. And that's not great, but it's certainly not making any history at this point. You know, we do have the price of oil soaring, with WTI up 35% for the year, and that's a huge move. But at $77 a barrel, it's really just back to where it was in January of 2025, and that's not a price that would be considered historically a high mark, more of an average estimate of where the industry expects their pricing to be. And the biggest little story within all of this, at least as it applies to oil and the global economic ramifications that oil prices have, is that on Tuesday, it was announced that the U.S. government, through the IFDC, is going to go ahead and insure themselves the tankers that are seeking to travel through the Strait of Hormuz. And they're filling the void that's been left by the commercial insurers who right now aren't willing to do so. So while the ships might be able to and willing to transverse the straits, without any insurance on the boats, they just can't afford to do so. So this will facilitate that hopefully in the next few days or weeks. And this is worth watching closely, because if they can get that traffic going again, it will limit the economic impact this has on the markets and return an element of stability to all these systems. Now, it looks like they've taken a lot of Iran's ability to threaten the shipping lanes off the table. And if they can get that traffic going, you'd expect to see oil prices moderate quickly, only inhibited still by the now lack of Iranian oil on the market, which has a big direct impact on the markets of China and India, because they've been the ones that are comfortable to evade the global sanctions that have been in place for a long time now on Iran. They've been willing to go out there and buy this so-called gray market oil because they've been able to do so at a discount to what legitimate so-called oil has been commanding as spot prices on the global markets. Ultimately, longer term, well, it's still impossible to say how this ends up, but if there's a resolution that sees Persian oil returning to the markets in a more open way, more normalized selling of that oil eventually, coupled with the chance that Venezuelan supply is also brought back to the capacity that they have really the ability to reach that they haven't been at in years if their system wasn't in shambles, then the global supply of oil at that point would probably outstrip the current demand, and you could expect to see prices weaken quite a bit further, leaving only that supply from Russia in that scenario as the remaining major oil producer, only able then to sneak out their bandit oil to the Chinese ports on the cheap at these discounted prices. However, My point isn't to come on the show here and sound like Kevin Bacon at the end of the Animal House as he was sitting there screaming all as well as everything was burning down around him. The markets are hanging in there. You know, you might not feel that way, but the bottom line is they're hanging in there. But there's definitely a lot of wary eyes that are looking at the exit right now. And during that big sell-off on Tuesday, and that came after the markets had a big sell-off Monday morning, but recovered to about flat by the time the markets closed. And with no real news overnight that changed anything that I really discerned, we saw a big drawdown on Tuesday. And what was remarkable about that, I think, was that this sell-off was universal. Because money was coming not out of just stocks, but it was coming out of bonds also. Rates were going higher. Money was coming out of gold and silver. Both were down significantly on the day. Basically, all risk assets were trending down as cash was pouring into the sidelines. And that itself is basically a bullish sign because cash on the sidelines eventually, when stability is returned, finds its way back into assets and gives a boost. But the markets are wary today, and it's about more than just the war in Iran. What we have today is a market that's not particularly cheap on valuations, and it's confronting uncertainty about Fed monetary policy and the direction they've been taking. We got some serious doubts about the impact that AI is going to have on jobs and on software businesses. We have a smoldering private credit crisis kind of sitting there. And now we add to that a war in the Middle East. And multiple challenges compounded when valuations are stretched just doesn't work. And if you're priced to perfection, and maybe we're a bit shy of saying we're priced to perfection here, but we're pretty far from perfection right now in the economy. There's been some noise about the credit markets tightening, which, along with the higher price of oil, contributes directly to inflation and has this overall slowing effect on global economic growth. But it hasn't yet come close to being a real red flag here. A lot was made over the last couple of years. There was this kind of line in the sand that if the 10-year Treasury was yielding over 4.5%, that was this so-called tipping point where the U.S. economy would start slowing significantly. But today, that bond, that 10-year Treasury, is yielding 4.14%. And it's still lower for the calendar year than it was at the end of December, albeit higher than the low that we saw, which is 3.95% at the end of February. The SOFR rate, that's the rate that replaced LIBOR as this kind of key benchmark for many consumer loans and corporate loans, that's at 3.67%. It's exactly where it was a week ago before the trouble in the Middle East. And just at about its 52-week low, down from a high of the last 52 weeks of 4.51%, according to the rates that are published in the Wall Street Journal. And average rates on 30-year mortgages in the country right now are at 6.13%, also a match for a week ago, and down from a high for the year of 7%, and they were above that if you go back even further, but a good ways off of those sweetheart rates that many of us were refinancing at during the COVID years. But that should not be used as a benchmark. Don't expect those rates to be anything but anomalous in history. It was great getting a 30-year mortgage for less than 3%, but a return to that would be pretty remarkable. This all does, though, throw a wrench into the machinations of monetary policy. But in a report from Goldman Sachs this week on the effects of the war on the economy, they said, quote, "The global monetary policy outlook will be mostly unaffected under our baseline forecasts, but could turn more hawkish, likely via delay in rate cuts, if oil prices temporarily rise to $100 a barrel or if higher costs pass through to prices at higher than normal rate," end quote. So yeah, if this does persist or if it worsens, it could take the anticipated rate cuts for this year off the table, maybe more so in Europe, although the euro and the pound have actually weakened versus the dollar this week, not reflecting an expectation that their monetary policy is going to become more hawkish than ours, but that their economies are going to be that much more vulnerable due to the effects of the war. And speaking at a conference this past Tuesday, the Minneapolis Fed president, Neil Kashkari, he supported the likelihood of 2 rate cuts later this year, in line with what the dot plots have been telling us. But he cautioned that the war could potentially create conditions that may require extending this Fed's pause on interest rates. And in a somewhat self-deprecating manner, Kashkari went on to say that he was on, quote, team transitory, end quote, regarding a pickup in inflation after Russia invaded Ukraine. And the effects were much higher than and lasted much longer than he expected. And he doesn't want to repeat those mistakes today. So he is getting a little bit more hesitant to prescribe more rate cuts. And while Kashkari said he believes the Fed's rates are now at about the neutral rate here, Fed Governor Miron said in an interview this week that he believes that the neutral rate is actually 1% lower than we are today, and that they're still firmly in restrictive territory right now, which he wants to move away from. He said regarding the war that those at the table at the Fed, they're right now basically in the same place they were a week ago, and he wants to see a series of 4 quarter-point cuts to get them to his projection of what the neutral rate is, as there are still, in his words, signs that the labor market needs support here from more monetary policy. So it's really obviously too soon to tell. As I speak, the markets are having another tough day here on Thursday, but the signals are that Iran's capabilities have been rather anemic in their response, and it's encouraging that oil volumes apparently may not be impacted for very long. The best perspective I got from this week was from an interview with John Gray, president over at Blackstone, and he gave a broader perspective and one that's more pertinent for an investor with a reasonable time horizon here. Basically, he just said, and he said a lot more, but what struck me is that he said that to look beyond today's headlines, which may affect the next couple of months, but as an investor, instead of a trader, continue focusing on the mega trends. Those trends which will persist through the economy and will do so for many years to come. He pointed out that after the so-called Liberation Day last year, it looked like 2025 was going to be a pretty bad year in the markets, but it didn't last too long. That while the leveraged speculators are the ones that are going to race for the exits, the long-term investors instead should be looking for opportunities to allocate into these mega trends while they're still briefly on sale. And with that, I'm going to take a short break, but when I return, I'll try to put this all aside and we'll focus on one of those mega trends with an update on a company within the portfolio. For the Wise Investor Show, I'm Chase Hinderstein, and I'll be back with that in a moment.
The unwieldy fire hose of daily news flow is only getting stronger. How do investors separate the noise from what actually matters? Tune in every week as we discuss the latest financial trends and how to filter what's distracting you from investing success. Listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. In the fog of war this week, we got some results from a holding in our portfolio. That means it's a company which we own for our clients and I own personally, so caveat emptor. I come at this with an upside bias to the name and an interest in the company doing well. But Broadcom released their first quarter results on Wednesday night, and as I speak here on Thursday, the stock is outperforming the S&P 500 for the day by about 5%. which is to say it's up about 4% right now as the market is down about 1%. And that market is impacting the stock, unfortunately, today because the stock was up quite a bit higher this morning. They had a big year in 2025. The stock was up 50% for the year, and now it's down about 5% this year. It's down 21% from its all-time recent high, as it gave back a lot during the recent tech sell-offs and question marks about the persistence and viability of AI. For the quarter, Broadcom had earnings of $2.05 a share versus the estimates, according to FactSet, of $2.03, on total revenues of $19.3 billion. They increased their guidance for the current quarter ahead of the street's estimates. And on the conference call, the CEO said that he expects revenues from chip sales alone to exceed $100 billion next year. He also went on to say that those chips are going to require a lot of power and that they have the supply chain in place to deliver on those orders, which he said they have dramatically improved visibility into the factors that are going to drive those sales. Now, bear in mind that chip sales reflect about 2/3, maybe now getting closer to 3/4 of the company's total sales. And the street estimates are that next year's sales would be about 50% higher than this year, which are on track to be about 50% higher than they were last year. And despite the pullback from its recent highs, the stock has had overall a strong run. But based upon these ongoing results, please note that the relative valuation to earnings here, the stock is really as cheap relative to earnings as it's been in 2 years. And in reaction to the results, an analyst over at RBC said that the current guidance was solid, but the fiscal year commentary was even more upbeat. He said that the 2027 target requires a steep ramp up elsewhere in the sector, notably that it faces potential data center and power constraints. That's a continuing theme through all this. They keep talking about the need for power, the need for infrastructure that's going to enable all these projections. At Cantor Fitzgerald, the analyst there suggests that based on commentary at Broadcom's top customers, their AI revenue may eventually reach $150 to $200 billion, roughly double what it is right now. He says they're confident that customers have secured enough power to reach these goals. And at Goldman Sachs, they said that management's commentary should address the key issues investors continue to debate on this stock. Goldman Sachs, focus on the supply chain as a key component satisfying investors' questions, as it has, quote, secured supplies of all key components needed to support its revenue forecast through fiscal year 2028. Now, as seen in these results, Goldman notes that their growing scale, the company's growing scale, should help Broadcom maintain its current margins on their AI products. They remain a buy on the stock. They have it on their conviction list, and they raised their 12-month price target to $408 a share from $450 a share, raising their revenues for this year by 6% on their projections, but their revenue projections for next year by 33%. And that $480 target, it's about 20 times Goldman's estimate for 2028, which actually would end up being at the low end of its average 10-year valuation multiple. All right, that's about it for me this week. There's going to be a lot of knocking around the markets for the next couple of weeks. It's going to be stuff that's just impossible to predict. So a lot of money is going to slosh to the sidelines, rush back in. But remember the words of John Gray and focus on the macro trends, focus on your time horizon, and think about it in terms of like a company like Broadcom, which I didn't use accidentally here to tie into this, as it's seemingly evident, given a reasonable period of time, investors with that time, that they can use this volatility to take advantage of more attractive pricing when the stocks sell off, despite today's news having very little or maybe no impact on these mega trends that are coming over the next 2, 3, and 5 years. For the Wise Investor Show, I'm Chase Hinderstein. Thanks for tuning in.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the WIG Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.